All right, let's get right into it, because what we have here is a real head-scratcher, a genuine financial mystery. We're talking about Tapestry, the parent company of Coach, and their latest earnings report. On paper, it looked amazing, but the stock market? It had a completely different idea.
And that really brings us to the core question of this whole explainer. How on earth does a company report fantastic numbers, beat all the expectations, and then just watch its stock price completely fall off a cliff, down almost 16% in one day? It feels like it makes no sense, right? Well, today, we're going to pull back the curtain and see exactly what happened.
So this is where it gets really interesting. On one hand, you've got the beat. Tapestry's revenue and their earnings per share both came in higher than Wall Street was forecasting. That's a textbook win. But then you look at the other side, the bleed. The stock took an absolute nosedive. This is the paradox, and all the clues to solving it are buried deep inside the report.
So first, let's start with the good news, which honestly was way better than good. The main engine driving this whole company, the iconic Coach brand, wasn't just chugging along. No, it was having a truly phenomenal year. The number that just jumps off the page for Coach in Q4 is this: a whopping 14% year-over-year revenue growth. I mean, in the affordable luxury space, that is a massive number. It shows the brand is absolutely firing on all cylinders.
And this wasn't some kind of fluke. The company's own CEO, Joanne Pivarat, came right out and called it a breakout year. You can see from this quote that the feeling from the top down was pure confidence. They felt like they had incredible momentum. So what was behind it all?
Okay, so how did they pull this off? Well, get this. Coach brought in 4.6 million new customers just in North America. And the really key part? Almost 70% of them were Gen Z and millennials. They were hooked by new products, especially the super popular Tabby bag. It's proof that Coach has really figured out how to connect with a whole new generation. This is exactly what a healthy, growing brand looks like.
But, while that Coach engine was just roaring down the highway, another part of the Tapestry machine was seriously sputtering. And that brings us to the flip side of this story, the major problems brewing at their other big brand, Kate Spade. And when you see it side by side, the difference is just staggering. You've got Coach with that explosive 14% growth, and then there's Kate Spade with revenue dropping by 13%. That is a 27-point gap in performance between the company's two core brands. You can imagine an investor looking at this and seeing one brand flying and the other one sinking.
The problem got so bad that Tapestry had to do this: take an $855 million non-cash impairment charge. Now, in plain English, that means they had to officially admit on their books that the Kate Spade brand was worth way less than they thought it was. For the market, that is a huge flashing red flag.
Now, management's explanation is that Kate Spade is going through a reset. They're cutting over 30% of their handbag styles and trying to refocus the brand's identity. You could really think of it as brand rehab. And while that might be the right call for the long run, in the short term, all the market hears is pain, lower sales, and a whole lot of uncertainty.
So, you've got one brand killing it and another one in trouble. That alone would make investors nervous. But then, something else hit, a complete surprise, an external shock that came out of nowhere. It had nothing to do with fashion and everything to do with politics and trade.
The culprit was a sudden change to something called the de-minimis exemption. Basically, this is a trade rule that lets you and me import stuff up to a certain value, it was $800, without paying any taxes or tariffs on it. A lot of companies, including Tapestry, built their e-commerce strategy around this, but then an executive order just ended it, way earlier than anybody saw coming.
And the financial fallout from that was immediate and ugly. The company said this tariff change would create a 60-cent per share headwind for the next fiscal year. We're talking about roughly $160 million in pure unexpected costs that are going to hit their profits directly. For investors trying to predict the future, this was a massive shock to the system.
So you can imagine, with the stock in an absolute free fall, what did the company do? Well, they didn't panic. Instead, they laid out their game plan, basically arguing that these short-term headaches don't change their long-term strategy.
To fight back against that $160 million tariff hit, management rolled out a three-step plan. First, they're going to optimize their supply chain. Second, they're going to adjust their prices, which is always tricky. And third, they're going to push for internal savings. Now, these aren't magic bullets, but they believe this plan can offset about 30% of the damage in the first year alone.
And to show just how confident they still are, they decided to put their money where their mouth is. They announced a 14% dividend increase and a plan to buy back $800 million of their own stock. You just don't do those things unless you believe your stock is a bargain and you're committed to your shareholders no matter the headwinds.
So this all brings us to the final verdict. We're left with two totally different narratives playing out at the exact same time. You have the market story, which is all about short-term panic, and then you have the company story, which is all about long-term confidence.
And here it is, the whole conflict in a nutshell. The market looked at two things, that surprise tariff bomb and the messy Kate Spade situation, and it freaked out. But management? They're looking at the unbelievable momentum at Coach, their clear plan to handle the tariffs, and their strong cash flow, and they're just saying, we're staying the course.
And that really leaves us with the ultimate question, doesn't it? When a stock crashes like this, it feels like the market's reaction is the only thing that matters. But this whole situation is a perfect example of that classic tug-of-war between Wall Street's immediate feelings and a company's long-term vision. And it just makes you wonder, in the grand scheme of things, who's going to be right?